Let's get across the market open now. Kyle Rodder joining us from capital.com. Kyle, happy Monday to you. Let's just first start Friday, what we saw there. Bit of a mixed session globally. Wall Street managing to edge higher. I guess Donald Trump indicating perhaps he's likely to be flexible about those forthcoming tariffs in April.
Yeah, we're just trading on a lot of headline risk at the moment, really, until we get to that sort of April 2nd date when the Department of Commerce hands down its sort of reciprocal tariffs and sort of full scope of what that actually includes and how large they happen to be. Anytime we see a little sort of opening that perhaps there might be some clemency or some flexibility there, clearly markets are sort of moving higher into that, equities in particular. I mean, it has to be said that, this trade war uncertainty is capping upside in equities and, overall, while that persists, you sort of suspect that downside risks will sort of continue to prevail. And I think that'll be the theme of the week. We're about a week and a bit away from that April 2nd date when the Department of Commerce hands down that report, and it'll be just looking for any sort of clues, if it can be found, on what the policy will be, obviously what impact that will have on economic activity, and then on top of that too, what the likely countermeasures might be from some of its, the US's major trading partners. The EU over the weekend or on Friday night sort of flagged that it might use this anti-coercion measures to retaliate to US tariffs, and that's sort of the dynamic where things become a little non-linear and markets worry about where you get this race to the bottom. But overall, it remains the sort of the prevailing concern for the markets. The Fed last week maybe put a bit of a floor under things with some reassurance that it will step in to support the economy if necessary. But overall, we're just waiting for that report to come out and sort of be able to digest that to hopefully get a better sense of what's happening, and the markets can kind of, with a greater degree of confidence, price in the future.
We're just taking a look at what's on the calendar this week. In the States, I guess they've got PMIs tonight, but I guess the focus is going to be on those core PCE price index for February at the end of the week.
Yeah, I think the way to frame this is, looking at what need the markets or the economy might have for policy support from the US Federal Reserve, and then what scope the US Federal Reserve has to actually provide that easing if necessary. And what that is to say is that, if we do start to see signs that economic activity is slowing down, for example, if in these PMI surveys we see that activity is dropping off, employment and investment continues to kind of moderate or cool down because simply businesses challenge in planning for the future with so much policy uncertainty. If that sort of comes through, then it sort of indicates that the Fed may need to sort of cut rates a little bit sooner than expected, or will cut rates sooner than expected. But that's sort of counterbalanced potentially by the inflation data that we'll get at the end of the week, which will tell us whether the Fed will be sort of able to cut as aggressively. It has the wiggle room to be able to cut aggressively because inflation remains under control, ideally sort of trending downwards. It has to be said on Friday night, the consensus forecast for the core PCE number is 2.8%, which is an increase from 2.6% a month earlier, and kind of reaffirms that argument that over the last 12 months, prices have been sort of stuck in the high 2% level, at least in that core PCE range, arguably anchored at that level now, and that further cuts are off the table for a while to be able to get that lower. But again, it's all about counterbalancing how prices might respond to weaker demand. We'll get that look from the PMI surveys, and that's not just in the United States, but across the globe as well. And then again, the kind of wiggle room that the Fed might have to cut rates, depending on what the inflation data actually tells us.
Yeah, we've got PMIs locally today. Look, big week ahead, in fact, locally, because we've got the federal budget tomorrow night. It'll be an election budget, of course, as we head into closer to the election. And then, of course, next week we've also got the RBA. End of the week, midweek, in fact, we also got a read on inflation too.
Yeah, I mean, I think the federal budget shouldn't deliver too many surprises, obviously other than, the kind of COVID period where these things were, incredibly significant, and, uncertain, that, federal budgets really sort of move the dial much when it comes to, the markets on aggregate. Clearly there might be some beneficiaries at sort of a micro level, depending on the policies that come through. I mean, the rule of thumb, obviously, is that if it's, another deficit, which we've already been told that that's going to be the case on the margins, we're still running sort of expansionary fiscal settings, very, very slightly. slightly that the change in terms of fiscal settings might be fairly stable, but we're still running budgetary conditions that is largely stimulative. Maybe that's not such a great thing, or hasn't been such a great thing in terms of trying to get inflation under control. But nevertheless, we're clearly in a different paradigm now where the RBA is looking to cut rates and inflation looks like it's coming back under target. We'll get that indicator on Wednesday, and that'll tell us a lot about what that official number in April, when it's released for the quarterly CPI figure, to what extent that's coming in line with the RBA's expectations that we'll see a 2.7% number, say roughly, that the core trim mean CPI is between the 2 and 3% level. If we see that, again, of course, out of that official figure, the RBA probably will cut in May. The markets are going to be looking at this indicator to see that inflation seems to be trending in that direction, and that the traders can continue to price in that May rate cut, which at the moment, or at least I should say when I checked at the end of last week, is about an 80 to 90% probability. April's basically, 2 weeks' time, is basically taken off the table as far as a cut goes. So again, federal budget, not too much there probably in terms of market moving news. Market participants are going to be looking at that CPI indicator to sort of feel confidence that the inflation outlook is roughly in line with the data, and that the RBA will be able to cut interest rates in a few months' time.
And Kyle, overall, how would you assess investor sentiment at the moment, what we're seeing, particularly on the local market? No certainty, of course, that we have seen a bottom.
Yeah, still cautious, still not really back to kind of levels which you would say is, a screaming buy for the ASX 200 in aggregate. It has to be said that, we're dealing with a very expensive stock market, especially in some, fairly large pockets like the banks, which, make up such a significant weight. And even with the kind of 10% drawdown that we did see from the record highs, we're not even really back yet to kind of, the kind of average fair value, to use a kind of a crude term, that you would sort of look at from a price to earnings point of view, over the last sort of 10 years or so. We're still at, probably trading at a sort of 18 to 19 to 1 multiple. Over the last 10 years, the ASX 200's averaged sort of a 16 to 1 trailing price to earnings multiple. Obviously, you want to look at the forward earnings multiple as being a better indicator. But just as a rule of thumb, clearly we're still, not exactly screaming deep value. But, like anything else, we're being beat up because of this trade war uncertainty. Australia's economy is, highly sensitive to global growth and global trade. The ASX 200 is reflecting that. So here, just like everywhere else, we're going to be sort of waiting and watching for that, development on US trade policy. Once we get greater certainty there, that should help investor sentiment a little bit. But as long as that uncertainty prevails and, certainly the impact of tariffs starts to be felt, the ASX 200 will probably trade a little bit on the back foot. Sentiment will probably be a little bit bearish.